Welcome to Pressure Points. I'm Gene Munster from Deepwater Asset Management, and our topic today is the inflation numbers for the month of November and their impact on both mega cap and sub $50 billion market cap tech stocks. In terms of the numbers for the month of November, the headline CPI number was up 3.1%, as in line with expectations, and down from 3.2% in the month of October. The core number, which excludes the food and energy, was unchanged from the month of October at 4% and also in line with expectations. And so that slight decline in the headline number was because energy has come down, but the better focus is the core number, which is steady or stubborn, depending on your perspective. Either way is that I think that the commentary from the Fed is going to be that they're going to have to keep rates higher for longer. And what that for longer is most investors think that we're going to start to see some rate cuts in the middle of next year. And the for longer piece would suggest it's mid to late next year before we start to see some rate cuts. And so that's the setup. We're going to get to the pressure point here, and that is, what does this all mean for tech stocks? From the highest level is the Mag 7 has done well, in part because of flight to quality, flight to safety, but also because of this interest rate environment, which has created a dynamic where investors don't want to be owning some of these sub $50 billion market cap companies because they got slammed so hard when interest rates went up. And the reason why they got hit so hard was because, of course, these smaller companies have earnings that are further out, and higher interest rates means that the discount number is a little bit higher, which has a more significant impact on share price. So they're just simply more sensitive to rate changes. But my sense, and this is the punchline of the pressure point, is that I think even a steady rate environment, not even needing the rate cuts, is going to be favorable for those sub $50 billion market cap companies. It may not be in the first few trading days after the CPI number comes out or when the Fed has commentary, but I believe in the months ahead is that just having rates remain stable allows investors to more seriously think about investing in some of these companies that have been largely forgotten about over the past couple of years. And these are not necessarily small companies, again, sub $50 billion market caps. And so I believe that we're going to see a slight shift over the next 6 months to performance coming from some of these kind of mid-cap, smaller and mid-cap companies, a little bit less coming from the Magnificent Seven. They'll still do well, but I think the strength in the market is going to come from some of these companies because the environment is going to remain stable, interest rate environment remaining stable. So that's the pressure point. Stable is good for some of these smaller tech companies. And on behalf of Deepwater, I'm Gene. Bye for now.